Let's take a moment and talk about the difference between investing, trading, and gambling, because there is a big difference between the three, and it's important to know the differences. So if you think you're investing, but really what you're doing is trading or gambling, you really need to know the difference between that. Otherwise, you can kind of get in a lot of trouble as far as the returns or your success. So let's look at investing. So investing is really, think of that as long-term. It's a long-term play when you're talking about investing. It's not a short-term fix like gambling might be, or hoping to hit a home run or anything like that, in a very short term. It's a long-term play is how I would characterize investing, and you're really investing towards specific goals. You are putting in money to get a return on that money, to grow your money so you can reach a certain goal, whatever that might be, saving for college or university for a family member, or saving for your own retirement or financial independence are very common investing goals. So you're saving for a specific goal, and that you have a plan around it. And that's a big part of what this course is, and my Investing Success course is all about, kind of planning and how to have a plan around it and sticking to that plan and executing the plan. So investing, long-term play, specific goal, you have a plan, you rebalance as needed. So if your stocks really take off, or a certain part of your stock portfolio, maybe a large cap stocks or technology or something we're going to learn about later in the course takes off, well, then you can rebalance to kind of put your portfolio or everything that you own back in place, but it's still going towards that specific plan. You're still making these adjustments for the long term. And you can really succeed with investing with long-term basic principles that you can use over time. As we've seen and as we know about investing over time, it's all about time and time value of money, and let your money work and compound interest and all that working in your favor. So investing can be a little bit boring at times, but it's really all about that long-term play and saving towards those goals. Let's compare that to trading, because they're very close. They're closely related. Trading should be fun. I do some trading, and I'll talk about at the end how I invest, how I trade, and even how I gamble. And trading is fun. It's more of that short-term play. Maybe it's something you're looking at, buying a particular individual stock, or something you might be trading or making more frequent moves. So if investing is more along the lines of, let's say, buy and hold, even some active part, but let's say more buy and hold for a long term. Trading would be something that'd be much more active. In fact, there's a concept called day trading you probably have heard of, where you're basically trading multiple times in a single day, trying to get that little bit of edge as you make these trades. So trading can take a lot of work. It might also need more money, as far as if you're a frequent trader and you want to have at least some diversification of 20 to 30 stocks that you might be trading in and out of frequently. So think about that as far as your investment of time, and concepts you'll learn in this course you can use in trading or investing, but think about your concept as far as the time that you have. And also, you'll incur more transaction fees if you're doing lots of trading. So when we talk about fees, you'll learn about how each time you're buying and selling, you're incurring fees. So the more trading you're doing, the more actively buying and selling stocks each time that incurs a fee. So understand that your overall return maybe even looks great. Maybe you're a great trader, but all those fees eat away at it. And so many times a long-term investor will certainly outperform a very active trader in most cases. That's why you hear a lot about like index mutual funds, where there's very little trading going on within the fund at all, because it's basically buying the index. And we'll look at those, but that's the concept behind that. The other thing with trading for individuals is you can really run into more behavioral issues too, and things to be aware of. A lot of times people might be not willing to sell their losers, for example, because they have hope that it's going to come back, the stock is going to come back, and they ride it all the way down when they should have really just bit the bullet and sold it. So there's behavioral issues. Or maybe you're chasing after winners because you're chasing after somebody that your neighbor or your coworker said, hey, this is a great stock, go buy it, and you're getting in late and you're really buying high, and maybe you missed out on that, and now the price has gone down. Or so you're not buying high, and you're not buying low and selling high, you're buying high and then selling low, which is, a loser's game, of course. So be aware of that with trading. Do you have the time with that? Do you have the behaviors to make it work for you? Understand, to get more diversification, if you're doing lots of trading, you might need more money for trading individual stocks. And it's really all about succeeding by personal skill. So it's you thinking that you can beat the market, that you can beat others who do this maybe full time, immediately looking for those little edges. And I do a little bit of it too. And I'm very successful with that, but that's not my whole portfolio. I'm more of a long-term investor with some trading that I kind of do for fun. Remember that first part about fun. Now, gambling, if you gamble at all, that really should all be about fun. I mean, if you're gambling to try to think you're going to beat the house or be real successful, especially over the long term, that's really hard to do. If you're very successful at that, don't even take this course. Go gamble and be successful gambler. Maybe take a gambling course. I don't know. But the idea is that, gambling is, if you do it, is meant to be fun. You want to try to limit your losses, but the idea it's fun. It's not investing and it's not trading. It is gambling. And one thing that, any, person, many people will tell you is when you gamble, kind of expect to lose. I mean, think about these big, massive casinos that you see out there in Las Vegas or Monte Carlo or wherever across the world, these big, hotels and casinos. Well, they're funded on gambling money, your money and my money, right? So they're making a lot of money. So if they're making a lot of money, who's not making a lot of money? Well, it's the individual gamblers. So I approach gambling like if I'm going to gamble for fun, bet on horses or play cards or whatever it might be, that there's an expectation to lose and I want to limit my loss. Really, if I go to the track, for example, once or twice a year, I might go, watch the horses race. It's fun. They're beautiful animals. But I only bet very small amounts, $5 US or less sometimes, and only money that's in my pocket. I don't bring credit cards or anything like that. I'm just willing to lose a small amount. It's more about having fun than trying to, make a big score, so to speak. So one question might be, is something like day trading where you're frequently trading, is that kind of gambling? I mean, even in gambling, you're trying to evaluate, let's say, a horse or evaluate something and then make a bet on that. As day trading gets a little bit more like gambling, might be one way to think of it versus long-term investing where you put it and you invest your money and let it work for a long period of time. So that's something to think about when you're looking at investing versus trading versus, let's say, gambling. Now, for myself, to share, I'm all about investing. I'm a long-term investor. That's where I've had my success. And what I'm hoping you'll get out of this course is that long-term investing towards specific goals, rebalancing, making changes as you needed, and building a good, diversified portfolio. Those are the ways to success proven over and over again. So I consider myself an investor, in particular, a long-term investor. But I do trade too, as far as trading stocks. And you'll learn about, different ways you can apply these principles from financial ratios to whatever we're in the course here, so you can do trading as well. And I do that because, remember that part about fun. It's fun for me. It's interesting. It keeps me engaged in the market. It keeps me engaged in stocks. And I've had some success because I'm only looking at a narrow basket of stocks and I'm maybe actively more trading versus my long-term buy and hold type strategy. But it's really about fun, and I, make sure I watch my behavioral stuff, that I don't do something dumb like, buy high or sell low or something like that. Just be aware of that. But understand it's not like what I'm doing 100% of the time. I'm an investor with some trading. And as far as gambling, as I mentioned, I might bet on the horse every once in a while, but that's all for fun. Lose very small amounts of money. I think the most I've ever lost was like $20 US or $30 US, something like that. Keep it very small, and I've won some too, but it's all about going out with the family or friends and having fun. So take a step back as we go through the course and think about yourself. Am I an investor, am I a trader, or am I a gambler? And I'm telling you, for long-term success, err towards the investing side. You'll be glad you did. Did you know that I actually own Google? That's right, I own Google and Apple and General Mills and Johnson & Johnson and Wells Fargo, a big bank. I mean, I own all these companies. Isn't that something? Isn't that spectacular? Well, heck, you can own all those companies too, and that's really what a stock is. We're going to talk about. So what is a stock really? And it's really about ownership. You can be an owner. Now, I might have a few shares of these things, so I'm not worth billions of dollars like, some major shareholders. But heck, if I have one stock of Google, I'm an owner in Google, or an Apple or whomever. If I have one share, I'm an owner. I'm a small owner, but I'm still an owner. And basically, that's what a stock is. And we're going to talk about it from the perspective of a public company, something that's publicly traded that you and I can buy and sell stock in that company and be an owner and buy shares and be an owner in that company, or sell the shares and decide not to be an owner in that company, or maybe a smaller owner in that company. So that's what really stock is from a public standpoint versus, let's say, private ownership, or you're starting your own company or something like that. But publicly traded stock is about you having ownership rights. You're basically buying that stock or giving, in effect, the company money through, at least the original folks who were with an initial public offering. I mean, when they first bought into the company, they're an owner of that, and then you can sell those rights to other people publicly. So you're an owner, you have a claim on the company's assets and earnings. So you, as an owner, you have a claim on that. And as they do well, maybe they might pay a dividend based out of their earnings, every quarter giving you money back, or certainly you make money as your stock price rises up. Those are the benefits of being an owner. More risky being an owner because the price could go down, or they could cut the dividend, or go bankrupt, or all sorts of things. So a publicly traded stock is sold on a market like the New York Stock Exchange or NASDAQ or Nikkei or all these different types of exchanges that are out there where stock is publicly traded and you can buy and sell stock. You have voting rights because you're an owner. Now, if I own one share of stock of, let's say, Google, and there's lots of shares out there, I have very little power on that, but you do have voting rights. Sometimes you'll get like things in the mail where I'll ask you about, to vote on something on the new board of directors or a change in the company order. So sometimes you get voting things with there. But for most folks like you and I, it doesn't really impact that much as far as the company. But big major institutional investors where they might own, let's say, 10, 20% of a company, especially a smaller medium type company, they're very, very strong and very powerful because they are owners in that company. Now, you're not involved with the day-to-day operations, so I'm not deciding whether the Google self-driving car is going to be released next month or something of that nature, but I want to be aware of what's going on with the company so I can decide whether I want to continue to own it or maybe I want to sell it and invest in something else. But you're not involved with the day-to-day operations. And the idea of owning stock from our perspective, from an investing standpoint, is we want to get a return on our money. We like being an owner, that's nice, but we don't get lots of benefits from it. Really what we want to do is invest that money, have it grow, have it get a return on that investment, and then be able to later use that investment to fund things in the future, things we want to buy, a home or college or retirement or financial independence, or maybe leave some money to our heirs, after we die, to help set them up for their future. So there's all these reasons why we invest, and we invest in stocks to get a return. And one thing about investing in stocks is we're looking to get a better return because it's more risky. Stocks are more risky than many other asset classes or other types of things like bonds or cash, which is much more safe, for example, or gold or different things that you can invest in. Stocks is a part of your overall investment strategy and part of your portfolio by investing in stocks. And that might be a more riskier part of your portfolio, probably the most risky part of your portfolio actually for most people. And it's the one you expect the biggest return, especially over the long term. And that's why people invest in stocks, and we're really looking for long-term returns by being an owner, by buying in the stock. So stocks can have real short-term way ups and downs as far as movements, but over the long term, they can be very, very successful compared to these other assets, and that's what we're looking for. So that's really what a stock is. And so if you own a major index fund, let's say like the S&P 500 fund, which is the 500 largest United States-based stocks, heck, you own all sorts of stocks from McDonald's to Coke to Google. So, congratulations, you're an owner now. So where do stocks fit in a diversified portfolio? A portfolio being think of it as a basket of your holdings of your investments that you have, your various investments. Maybe you have some cash investments or bond investments, or you have precious metals like gold, silver, you have investments there, and investments in stocks. And within stocks, you have individual stocks or mutual funds or exchange trade funds, a lot of different variations, of course, on that. But your portfolio is basically your whole basket of all your holdings that you have as far as your investments. And so where do stocks fit in there, and how does that kind of relate to your risk tolerance? And a couple ways to look at it as far as building a portfolio. One is to think about how far away is your goal. If you're saving money, let's say, and you're investing money because next year you want to retire, let's say, for example, well, if you're buying stocks today that, a year from now you want to retire, that is a very, very risky move. See, stocks are, have a lot more volatility or risk, as in they go up and down frequently, actually every day, but sometimes they can have wide swinging periods of return. So stocks typically are looked at from a risk standpoint as far as a longer term investment. I've seen folks say like 3 years or more, or things of that nature as far as holding stocks. You might even want to be even going beyond that. But the idea of investing in stocks is a long term, think long term, versus let's say investing in cash where you get very little return on your cash, but it's something you can get at real right away and you're not expecting a great growth on it, but you're not expecting it to go down either. It's not going to go down 10% in a day like an individual stock may. So think about when you're building a portfolio and where stocks fit in is how far away is your goal. The further away it is, the more stocks that you can have as far as a risk idea. Think about your risk tolerance, and there's various tools and things we'll look at online in the as far as different tools you can look at to determine your risk tolerance. But even without using a tool to figure out your risk tolerance, you kind of know in your gut a little bit, like, when stocks go up, yeah, everybody feels good about that. But how about when they go down? How if they go down 10, 20, 30%? What if your stocks went down 30% in 2 months? What would you do? Would you sell? Would you feel really uncomfortable about that? Or would you be enthused and want to buy more of the stock, thinking you're getting them on a bargain basement deal? So if stocks go down 20% and you look at it as, hey, what a great buying opportunity, I'm going to take some of my cash and buy more stock. Well, you're a very risk averse, or you're a very risk aggressive investor. You're like, I want to take on more risk to get more return. If it's down 20% and you feel queasy or very nervous about it, well, then you're more risk averse, and that's okay. Just the key things you want to understand is where you're at on risk tolerance. Stocks are more risky, and so the more stocks you have in your overall basket of investments, your portfolio, the more your overall portfolio will go up and down. Particularly that down part is how do you react when it goes down. So understand stocks are more for the long run and are more risky, and understand how that relates to your risk tolerance. Lastly, think about need too. When are you going to need the money? Well, that's how far away is your goal, but what is it looking to do for you? Are you looking to invest in maybe stocks for a long period of time where you want them to grow and grow faster than inflation and grow very well because you're not going to tap into it for 20 or 30 years? Well, then you can take on more stocks, or you can take on more aggressive growth stocks. Or maybe you're like a retiree right now. Let's say you're going to retire in a year, or you're going to retire and you have a lot of income producing things like cash or bonds, which are made to give you income. Maybe you want to supplement that with a few dividend type paying stocks or dividend mutual funds, things that pay out income that are dividends, but they get you a little bit more growth because there's still a stock, still more risky, but less risky than, let's say, a high tech stock, for example. But it's a less risky stock that'll still pay you every quarter some money or income, and you have that be a small part of your overall portfolio or basket of your holdings. So think about how far away is your goal, how is your tolerance for risk, and then kind of what you're needing out of this. Are you needing growth? Are you needing income? Are you needing a combination? Do you need safety? In that case, you might be have very little invested in stocks. So those are three big things to consider to get you started with that. And the next lesson, we're going to look at some sample portfolios. Like, well, okay, this is nice, but do you got some ideas? Like if I'm a moderate investor or aggressive investor, what might be some ideas of returns and some ideas of some basic portfolios, what percentage to put in stocks and what percentage to put in something else to just at least help me get me started, at least start thinking around that? Well, we do, and that's the next lesson. So let's look forward to that next lesson and learn about different ways that we can make up a portfolio with a variety of assets, including stocks. Okay, so a big question is, how much should I have in stocks as far as where I'm at in my life in relation to my goals? And is there some kind of guidance around that? And there is. If you search like portfolios or stock and bond portfolios or portfolio allocation on the internet, you'll get a lot of different sites and things giving you maybe different information around how to build a portfolio. I'm going to share one with you here because I think it's really good and gives you some actual numbers versus just guessing or theory or saying you're a moderate investor, so you should be 50% stocks, 50% bonds. It actually gives you some historical data too, and it happens to be from Vanguard. So here's the link is on the slide. But if you're looking to go to it, basically search Vanguard. And under model portfolio allocations or model portfolio, if you put Vanguard model portfolio, you'll find it pretty easy. But you can see the link up the top here too on the screen when we take a look at that. So basically what Vanguard is going to show you is it's going to look at some average annual returns. It's going to show the best year, the worst year, and the number of years with a loss. And you get a feel for how much is these different asset classes in there. So let's take a look at that, and you can kind of start figuring out, well, where might I fall when I'm investing in stocks and other investments in far as these different types of portfolios? Okay, here we are with some sample portfolio allocation models. This is from Vanguard. You can see the link at the top here. Basically, if you just search Vanguard model portfolio or model portfolio allocations, and with Vanguard in the name, you're going to find it. Otherwise, here's the link. You can certainly look at that and grab that. So basically, these are model portfolios. And they'll get an idea of different risks and things as you go through here, but you can see it's looking at stocks and bonds, and then like the green would be like some short-term cash or things like that, looking over a long period of time. So if we look at, let's say, the first one, which is 100% bonds, that means there's no stocks in there at all. You can see a return of like 5.4%, and the best year was in 1982, 32% on bonds. Wow, that was something. And then the worst year, 1969, down 8.1%. And then years with a loss, as we go through, you'll see how this changes 14 years there was a loss if you had a portfolio where you only invested in bonds. You didn't invest in stocks at all or any other instrument, just in bonds. And the Vanguard breaks this down by different categories. This happens to be the income category. As we go forward, you'll see some moderate and growth in different types of categories. So in this income category, as you can see, they've got bonds, but then they have like 20% stocks, 80% bonds, 30% stocks, 70% bonds. So some ideas of different things. If you're really looking for income, regular income coming in on a quarterly basis, and you're really looking for income, less about growth because there's very few stocks in there, 20 or 30%, and more about income. And you can see as you add stocks, the returns go up. You get the 6.7, 7.2, because over time, stocks will outperform bonds over a long period of time, and this is over a long period of time. And you can see the years with a loss because it's riskier. Here at 20% stocks, 80% bonds, you have 12 years with a loss. Actually, versus 14, this is a unique thing where by adding stocks and adding various investments, it actually reduces risk. It is kind of a funny thing. So if you look at this, and this is true, this has been studied quite a lot, and you can see the best years and the worst years. You can see there's more volatility, bigger ranges, those kind of things. But if you look at it, you'd say to yourself, wow, I could get a better return over time. This is all past performance, and I don't guarantee a future performance. But over time, if I invest 30% in stocks and 70% bonds, well, I can get a better return and still have the same downside as far as years with a loss if I was 100% bonds. In fact, I'd be even better with years with a loss with 20% stocks and 80% bonds. So if you're an income investor looking at this, you might say, hey, I might want to add some safe dividend stocks. They'll pay me regular income. I need the income, but maybe I'll get a little growth. And actually it helps reduce my risk as well. So this is the income category. This would be good if you're already retired or very close to retirement, or where you're not looking for growth over a long period of time, and really to kind of set it up. Now, let's say if you want a more of a balanced type fund where you're trying to reduce volatility. That means you're reducing risk. You're reducing how much it goes up and how much it goes down. You're trying to limit those short-term fluctuations, as it says here, and it's thinking about more mid to long-range investment time horizon. So it's not super long time horizon, but more of a mid. This is also good if you're looking for something a little bit less risky and less volatile. And you can see here, they have different mixtures again, 40% stocks, 60% bonds, as you keep going through here, 50-50 and 60-40. And you can see how your returns start going up too. The more you add stocks, the more your returns go up. You can see these best years, worst years. You can see how your best year, when you get a 60% stocks, 40% bonds, pretty high, 36% in 1 year. And the worst year was down 26. Now this is old. This is back in the 30s. So this was when it was very volatile. You were looking, right at the right after the Roaring 20s and Great Depression time. So understand that, and you want to look at a more recent number. But it gives you an idea of how volatile it is. Also, it gives you an idea. I like this years with a loss because you get a feel for if I'm a risk-adverse investor. Well, I might like this because I got more stock, but I'm only going to go down 16 out of 90 periods, 90 years. Versus going up here where I'm up to 21 now out of 90, and I'm eking out a little bit more return, but I'm going to have more risk as well if I'm 60-40. But this is kind of considered balance as far as like more of a balanced type approach. Maybe you're getting closer to these mid or even a long-term investment, but maybe you want to be more risk averse with your long-term investment, or you want something more balanced, or maybe you're getting closer to something like financial independence or retirement, and you want to start mixing in things like bonds and stuff to help reduce that rate, that possibility of going down in those big losses. As we go to growth here, sample portfolios, once again, 70% stocks, 30% bonds, 80-20, 100% stocks. You see a lot of people with who are younger or have a long time horizon, especially going to the 80-20, maybe 70-30 to reduce it a little bit in terms of risk. But if you got a long-term time horizon, you don't mind short-term fluctuations, and especially if you're okay with big fluctuations, then you might want to go 80-20 or 70-30. And you can see, at 70-30 now I'm at a 9.1, and then I go to 9.5. At least historically, this is not necessarily what's going to happen the next year or two, but historically, and you can see these best and worst years with that. And then years with a loss, 22 and 23 as far as years with a loss. So that means out of 90 years, 22 of those times I'm going to have a loss, even with those mixes, or 23 times, and I'm able to get out better performance. Now you might have 3 years in a row with a loss, and they might be significant big losses. And you have to understand your time horizon, and can you withstand that when you're building your portfolio as far as the mix of stocks and let's say bonds. If you're looking at this and saying to yourself, well, if stocks are so good, especially if I have a long time horizon, I'm in my 20s or whatever, I'm like, let her ride, let her roll. Let's go 100% stocks. Hey, you could do that. You could go 100% stocks. You can maybe get some big average annual returns. You can see the fluctuations are pretty wide. I could be up 54% one year, down 41%, or excuse me, down 43% the next year. You know, this is good questions when you look at these growth type portfolios. If you're down 30% or 20% in a year, what are you going to do? Are you going to hold on, which is good, and maybe buy more? That's what you should do if you're in this growth thing. If you sell, then you're buying high and selling low, which is the exact opposite of what we want to do. So if that is scary for you, then you might want to go back up into those more balanced type things, even if you have a long time horizon. But if you want to get better returns, at least proven over time, and have a little bit more risk tolerance, you can take on more risk, then more stocks for the long term is a good way to go. You start getting 100% though, that gets a lot scary for a lot of folks. But I see a lot of people in the growth phase, certainly for myself. I've been always running like 80-20 for a long period of time. Even now, you know, as I'm older guy, I'm still more in the 80-20, 70, between 75 and 80, and I'm getting closer to some of these goals, of course, just because I have that higher risk tolerance. I'm used to it over the years. So in the bottom here, they give it a description of how the methodology they use. They're basically using indexes, looking at wide indexes, so they're not looking at individual stocks or anything. They're trying to give you a feel by using wide indexes. So it's a nicer methodology. Nothing's perfect, but it's a nice methodology. So if we scroll back up here, a good way to start with this is say, where am I at in terms of my goal? How far away am I? What's my risk tolerance? What's my need? Do I need income or do I need growth? And then find out what big bucket you're in. If I need income because I'm in retirement or very close to it, well, this is maybe what I'm looking at. Maybe I like that 30-70. If I need something a little bit more risk adverse and I need a little more balance in my portfolio, well, then maybe I'm at these 40-50% levels of stocks and bonds and then I can even put in more cash and things to help reduce risk too. You can put in other assets as well, but this is simple cash and bonds that they have here. And you can look at these numbers and kind of scroll through these numbers. And then if I'm like, no, I want to grow my funds, I want to grow my money, that's why I'm investing in stocks. Hey, that's why I'm taking your course. Well, terrific. Glad you did. So growth-wise, then you might want to be looking at these 70-30, 80-20s. 100%, you better have an iron stomach if you want to do the 100%. And certainly make sure you're diversified. Don't put 100% in two stocks. Make sure you get some nice exchange trade funds or mutual funds, or at least hold a nice portfolio of 30 stocks or so to help give you give you at least some diversity if you want to go that route. That's the nice thing with like a mutual fund. You can get hundreds of stocks by basically buying one fund as far as that diversity. But growth is all about more risk, more volatility, but that better long-term growth. So once again, you can get this in yourself, print it out from the Vanguard Group, search model portfolio allocations. And over time, and as you get used to your investing, or become more experienced with investor, you might shift between these different portfolio allocations, and that's good as part of rebalancing. But right here, my whole goal with this was to give you an idea of what might look like in terms of portfolio, and I really hope this helps you as far as when you start deciding how much stocks you want to buy, and then in there we start getting down into more detail, like what types of stocks to buy: dividend stocks, growth stocks, international, large cap, small cap, all these different things we can look at to build the subparts of this portfolio. But from the macro level, at least this gets you a start, and there's other tools out there. But I hope this gives you a start and gets you on the right track and gets you a feel for what your portfolio might look like now and in the future.